Good morning, everyone. I'm Martha Stokes. I'm a chartered market technician, which is important because I am a professional that is SEC licensed. And you don't get to speak to many people who are on the professional side of the market. Mostly you're talking to retail gurus and people who want to be famous, that type of thing. So I'm in my retirement and I love to teach. And I'm trying to help you learn about the market in a way that you do not hear from other commentators on TradingView and other places. So what we're having today is Microsoft, and it was in this big downtrend, and there was just negative news, and yet they had good earnings reports, and then more negative news, more negative news. CEO was saying, no, we're going to have a stellar earnings report. We're going to have a really big earnings report, and they did. So we're looking at this chart and we're trying to understand. Were most of you surprised last week when suddenly the market went from down to suddenly reversing? It was all in the charts. We were warned early time. The hybrid leading indicators and all the other indicators that showed that there would be a sudden reversal. There was a huge signal on the indexes that there was going to be a big sudden reversal because that one day everything was starting to shift, but everything was still selling down at that moment. So did you get trapped in some selling short that burned you? You have to really identify with indicators that are going to tell you in advance what is going on. You also need to understand the difference between predicting the market, which gurus on the retail side are constantly doing, and financial websites are just predicting the market. Professionals don't predict anything. What they do is called predictive. Predictive tendencies, predictive behavior, predictive non-events. They know that there is a predictive pattern to how you react to false retail news, fake information, and non-event situations where you panic. The sell-side institutions make more money selling short than buying long because selling short does not require huge volumes of activity. All it takes is for the retail groups to suddenly stop buying, and then the stock price will plummet. If you were to throw a ball into the air, it takes energy to drive it upward, but the laws of physics will have it fall faster and faster. The laws of physics are in these stock charts, but you're not reading them correctly. If you were selling last week or the other weeks into this pattern that looked like a sell short pattern but was not, because the indicators had indicated that this was the final low of this stock right here. This was the final low. Hello. And there was even a lower low here signaling that this stock was going to reverse if it dropped into that. So this was the low that said, okay, selling short is not a good idea. I don't care what's going on. And we have a springboard pattern here that ran up nicely and was a very profitable trade for most of my students. And we have sideways action again where they got out early because it warned on the signal. The indicators are crucial. But you have to understand that the market is not predicting anything. They don't use the word predicting. They use the word predictive behavior. Your behavior patterns are very predictive of how you will react if something is going on. So they know that there's a lot of things going on, and the dark pools are nudging this price back up because they know it's going to be a great earnings report. Why? Because the CEO said so. But you don't trust the CEOs. You think the CEOs are lying all the time because that's what you hear from gurus. CEOs can't lie or they'll go to prison. Trust the guidance from the CEOs, but you don't. A lot of you don't trust that. They think, oh well, they're not giving us proper information. Yes, they're giving you information. They're very careful about what they say because the retail news has a tendency to exploit whatever they say, and they're just going, oh, again, I have to go through this. And we can see that there's this building of a push upward. Now, the professional traders are not worried about a couple of days that move down, and they're ready to go. They're just sitting there going, yeah, this stock is going to move because the earnings are great. And they look at it go, boom, boom, a gap, another boom, boom, up, 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 way beyond its support levels, way beyond the resistance levels, and so on and so forth, because it had a great earnings report. So now we're hearing that AI is in a bubble and AI is going to crash and the market is going to crash. Did you know that we're in a great bull market and it started in 2023? And it's the start of probably the longest bull market in the history of great bull markets, because there's so much new technology. AI is helping new technology. All the negative news about Microsoft drove it down because people were selling and selling. But the buy side institutions go, oh, bargain. I'm going to start accumulating this stock, and look at this beautiful little springboard. Look at this is a push. This is a hurdle push. And these others, again, this is another push. So there's candle patterns that you may not recognize within this that you need to pay attention to, because there are the old 1990s candlesticks and there are the modern candlesticks. And the old 1990s candlesticks were based on the Japanese rice commodity exchange of the 1600s, ancient Japan. And in the beginning, that was great. That was a great start in the 1990s, but this is 2026, folks. And the problem is that the candles have changed. Why? Because the buy-side institutions are creating smaller and smaller candles. The nudges from the pro traders are very small, but very precise. They have a preciseness to them that you can pick out after you identify it and you are able to see it. But instead of listening to retail news and deciding to trade a stock or not trade a stock, or sell short or buy long, you need to trust your instruments. TradingView has wonderful software, and it has a great list of different indicators that you can use. One of the things that you often miss out on is that when there is pro trader nudges or some accumulation going on by the buy side, that the volume will be lower. Now, how is that possible? Because the dark pools are setting up an automated order, not based on AI. The professional side is not using AI to predict where the market's going to go. They're not using AI to select stocks for them. They're far wiser than that, because AI can't do it. And some of you will be playing around with AI and suddenly realize that you get burned because it doesn't know what the difference is. Oh, it can say, oh, the market's probability or prediction, it's going to go up, and suddenly it's going down, or vice versa, like last week and this week. So everybody's caught off guard. It's like, whoa, what happened? Why is the stock market going up? Because the corporations are making a ton of money off of AI. Don't believe everything you hear. So the dark pools price points there's a new strategy. I think I've already mentioned this before, but I will mention it again, where they strike the penny. So there's all these orders coming through from you day traders trying to sell short or others selling. And the dark pools are going, wait a minute, we want to nudge the stock. So we're going to have a strategy that when we see a sell order on a penny spread, we will buy it. So the penny spread shows a red candle because they're buying on the sell side. And they're doing this off the exchanges. You can't see. They have an automated system and it does it for them. So all they have to do is set the timeline, because it's time weighted at average price. I will repeat that. They set a timer for a weighted average at a specific price level. So when your little sell short order gets into that, they will buy it and it reverses the stock to an upside or whatever. They're mostly trying to nudge upward because They see this huge, vast potential going on in AI technology and how extensive it is. Right now, the dark pools are accumulating vast quantities of all kinds of stocks. It's everywhere. And I see these penny spread nudges all the time. You're trying to sell or whatever, and they're buying on the penny spread. So they're filling your order. And they do it all automated. And it's really, really interesting to see how it forms on the stock chart. So now we have a stock that has gapped over resistance and run up and gapped up. So what do we want to do? Well, it's hitting right into this resistance level. So what would be ideal? Ideal would be a sideways trend. There's no such thing as a non-trend. There's uptrend, there's downtrend, and there's sideways. Sideways is a trend because all the little nudges and everything that are in here are expressing that pattern. So you have to be aware that there's more going on here than you are told in your retail news or your chat groups or whatever. If you were surprised that the market reversed uh, last week and started running up, and the indexes were running up, and they made a new high, you should not have been surprised. It was all in the charts that this was going to happen. I'm Martha Stokes, and I'm out of time, so that's my topic for the day. Trade wisely.